Okay, this is ACCA sample mock exam for December 2025. So it's going to be a mix of questions. We'll try to do section A and section B. Um, I will give explanation where it is absolutely necessary to give. Otherwise, I will not spend a lot of time explaining every question. I mean, I will be explaining, but I'll try to manage time somehow, which I'm sure I will not be able to. Anyways, we'll see question number one. Question one, it says that, okay, first I see the requirement always. Okay, first read the requirement so that you make up your mind that what you are going to do. It says calculate Agassi Company's cash operating cycle using the working capital ratios rounded to the nearest day. So we have to round it to the nearest day. Okay. Working capital cycle, we know that cash operating cycle is actually equal to receivable days plus inventory days minus payable days. So we need the days, number of days. We don't have that. The data is given. The following are extracts from the financial statements of Agassi Company. Revenue, which is 10% are cash sales. Cost of sales, which is 80% are purchases. So the total cost of sale is 2.7 million, but 80% are purchases. What is the difference? The difference the difference will be in calculation of inventory and payable. Because remember, when you have to calculate inventory days, so what you do, you say, okay, inventory days, I have to see what is the cost of the inventory, and then what are the payable days, for example. Okay, so payable days are 250, and this is cost of sale. I'll take the full. But when you talk about the payable days, so inventory days, when you talk about inventory days, you talk about the total cost of the inventory. But when you talk about the payable days are only about the purchases the money which you owe to your supplier. So then you cannot take 2.7 million full. You actually have to take 80% of that, because 80% of that is purchases, and purchases will form or would result in payables. Payables means the money which you owe for inventory, the raw materials. Okay. So formulas are rather straightforward. What I need to do, I need to calculate my inventory days. Then I have to calculate my receivable days. And then there is payable days. Okay. And of course, payable days will be subtracted. I'll try to make it slightly bigger so that you can see it. And how do we do that? Inventory days, of course, we'll talk about how much is your inventory is 350 million, receivables are 420 million, and trade payables are 250 million. And pay attention that assume a 360 days year. So for inventory days, I'll take the value of inventory, which is 350, divided by the total cost of sales, which is 2.7 million, and I multiply it with 360. Okay. For receivable days, I'll consider my receivables, which are 420 million, divided by my sales. But which sales? Only the credit sales. So it means that the total revenue, which is 3,800, I have to multiply it with 90%. So I'll use 0.90, and I multiply it with 360. So because they told us that the total sales are 3.8 million, but out of which 380 million, your 10% are cash sales. So receivable, it only belongs to credit sales. So credit sales are 90%. Similarly, when I do my payable days, I need to do 250 divided by my inventory, which is 2,700, but that includes labor and other things as well. So the money which we owe to our suppliers for purchasing raw materials, that is only 80%. So I put 0.8, and then I multiply it with 360. So you take it here, you put your equals to sign, take it here, put your equals to sign, and then you take it here and put your equals to sign. Okay. And then if I have to round it down, because they said that your answer should be round down to the nearest days, okay? So I'll do like this. It is 47, 44, and 42. So I would say 47 plus 44 minus 42 because payable days are subtracted, okay? By the way, because I'm in class, so I am showing these workings. When you are in exam, you do not have to show the workings. You don't have to do it like this. You can do it quickly. You can do it without formatting. So workings are not required for section A, section B. They are not important. For me, it is important because I am explaining you people, okay? That how to do it. This is question number one. It is done 49 days. Answer is option number B. Second option, 49 days. That's the answer. Okay. 49 days. If I move to question number two, which of the following is our weaknesses in using the financial statements to value an unlisted business? To value an unlisted business, you have to do business valuation. Now, you see that the first question was from chapter number 4, which was working capital, and the next question straight comes from, I don't know, maybe chapter number 13, business valuation. So that's a random thing. So which of the following is our weaknesses? So there could be one answer, there could be two answers. Which are the weaknesses for valuation of a business based on the financial statements of an unlisted company? Financial statements are governed by financial regulation. So if they are governed by financial regulation, that is not actually a weakness, that is actually a good thing. So this cannot be the answer. Financial statements do not represent the future performance. Yes, this is the weakness because when you value a business, you value it for the future. Business valuation is not done on the past performance, they are done for the future valuation, okay? And financial statements, they only present the historical data. They don't provide you anything about the future. So this is a weakness. Financial statements are produced on an annual basis. Yes, this is also a weakness because financial statements will be prepared somewhere here, which is the end of year this year, and then end of this year. But you might be doing valuation somewhere here. So when you do valuation in August or July or in September or whenever, the data is already very old. So this is also a weakness because financial statement data is an old data. So answer should be option number 2 and 3. These are the two weaknesses of doing valuation of a business based on the financial statements. The third question we start doing. Stone Company is expecting to deposit $25 million in 3 months' time. The deposit will be for a 4-month period. Stone Company is concerned that interest rates could fall over the next 3 months, so it wants to fix the rate of interest now with a forward rate agreement and has obtained the following quotations. So how much period they are, first of all, whenever you are doing FRA, why do you do FRA or maybe future option, whatever? You are doing hedging. You need to understand that am I doing hedging? What is my position? I mean, am I an investor or am I a borrower? Because if you have to borrow the money, then you are protecting yourself against increasing interest rates. Okay, because you are borrowing the money. So you are afraid that if interest rates go up, they will hit me. But on the other side, if you are surplus of cash and if you are investing money, so then you are not afraid of increasing interest rates because increasing interest rate actually is good for you. So in case you are surplus of cash or you are an investor, you are actually afraid of decreasing interest rates because interest rates will go down and your income might reduce. Okay, so first thing, you understand that what you are doing. So you are expecting to deposit. It means that you are not concerned about increasing interest rate, you're actually concerned about decreasing interest rates. This is just by the way of explanation. Now, whenever you do FRA, you need to make sure that what is the starting point. where when I'm going to borrow money or when I'm going to deposit the money, and for how much period it will remain. So you are going to deposit 3 months from now. So this is 1st of January. You don't have money today to deposit. You will have money on 1st of April. January, February, March, nothing. You want to start, or you want to put your money or invest your money on 1st of April, and then you want to do it in for a 4 months period of time. So you want to start in 3 months and you want to continue for 4 months. So total period is 7 months. Okay, this is this is how these how to say quotes for FRA are also given. If I see 3 to 4, now they write it down 3x4, or you can write down 3v4, or you can write down 3.4. What does that mean? That it means that it will start after 3 months and it will continue and it will finish in the fourth month. So this is the starting point. This is always the ending point. Always remember. So this first quotation is not for us. Why it is not for us? Because it will start after 3 months and it will end in the fourth month. So it means only 1 month deposit. We actually want to have three starting in 3 months and ending in the seventh month. So this first one is not your choice. What you need to do, you are going to talk about the second one. Okay. And when you talk about the second one, because you are going to put money in the bank, so bank has two rates. One is 4.7 and 5.0 for you, because you remember, if you are a borrower, the bank will say 5% you have to pay interest. Now because you are putting the money, the bank will give you 4.7. The second thing, which once you decide that this is my quote, now which rate is applicable, 4.7 or 5.0? Now because you are depositing the money, bank is not going to give you the best interest rate. Banks say, oh, I'm going to give you 4.7. But if you go to the same bank and you say, I don't want to deposit, I want to borrow, the bank will say, okay, I will charge you 5%. This is how the banks, they do buying and selling for themselves. So for me, the effective interest rate is 4.7. Okay, assuming the interest rate is 4.3% in 3 months' time, what will be the financial settlement under the FRA? 4.3% in 3 months' time. And remember that 4.3% is always for 1 year. So what is happening? I lock the contract with the, let me do it with the pen. It is quick. I lock the contract at 4.7%. The market interest rate is 4.3%. So I am happy because I locked the contract at a higher interest rate. I am a depositor, so I'm happy actually. And I have to multiply it because this is actually going to be my income or earning, 25 million. And then this interest rate, which is 4.3, sorry, 4.7, 4.3, this is for annual. I have to make it for a period of 4 months. So then I do it with 4 by 12. Okay. So if I pick up my calculator now, 4.7 minus 4.3, 0.4 into 25 million into 4 divided by, sorry, 4.7 minus 4.3 into 25 million multiplied by 4 divided by 12. Answer is 3333.33. This is the answer. So assuming the interest, what will be the financial settlement under the FRA? Under the FRA, 33333. The bank will give me $33,333. They will give me, not I have to give them. Okay. So this question is done. You want to ask something on this question, please ask. Okay, question number 4. Again, I will mark it here. It says select the type of financial market appropriate to each of the company's needs. MB company needs to convert foreign currency into domestic currency. So they go to foreign exchange market, not euro currency, foreign exchange market. Any foreign currency into domestic currency, go to foreign exchange market. Dell company needs to issue new long-term loan notes. Now, loan notes actually are issued or can be done in the money market. But because these are long term, so we are going for capital market. If they say that Dell company needs to issue loan notes, I would have chosen the money market. But because it said long term, I'm going for capital market. Benji company needs to issue new ordinary shares. Now, ordinary shares, and they want to issue new. So, whenever you issue shares for the first time, that is called the primary market. When the company issues shares, these are called prime. This is called the primary market. And once company issues shares and or company sells shares, then people start buying and selling to each other in stock exchange. That is the secondary market. But because they are issuing the new shares, that is a capital market. Carlo company needs to purchase short-term over-the-counter derivatives. Now, again, if you want to buy the derivatives, you can go and buy it from the secondary from the money market. But it says over the counter, OTC. When you are doing OTC, you are going to the primary market, which means because over the counter is not the open market. Open market is called the secondary market, open stock exchange. So therefore, answer is this one, primary market. Okay. And the answers are changing. Actually, this question, it is easy, but they are creating some confusion because you see loan notes and you say, oh, that's money market. But then long term, you see shares, new shares, uh, derivatives, probably here. But then you see over the counter, and then you say, okay, then it is primary market. Question 4 is done. We do question number 5. Buckland Marsh company has a current market capitalization of 58 million and has recently paid a dividend of $5 million. The dividend payout ratio is 70% and the return on equity is 20%. Return on equity means that the money which you invest in the business, how much it gives you. What is the cost of equity for Buckland Marsh Company to the nearest? Now remember that these are two different things. One is called return on equity. One is called the cost of equity. Return on equity is what the business is earning. Cost of equity is what the shareholders they require. Okay, so we need to calculate actually KE, cost of equity. And how do we calculate cost of equity? So for cost of equity, you have two formulas. One formula was the CAPM formula. You said RF plus beta into RM minus RF. Now, this is first formula, straightforward. But for that purpose, you need beta, you need market return, you need risk-free rate. That kind of information is not given. So I cannot use this formula. The second formula which I have, that is for the price of share, P naught is equal to D naught into 1 plus G divided by KE minus G. Here is also cost of equity. And I can say that KE, I take it there, is equal KE plus G is equal to D naught into 1 plus G divided by P naught minus G. This is one derivation of calculating the second one option. Okay, so we'll see which formula do we need. CAPM definitely we do not need. What we need to do, we need to use the dividend growth formula. We know that they have recently given the dividend, which is 5 million. Okay, we know that their market capitalization is 58 million. So instead of P naught 1 share, the full value of the company and the full dividend. By the way, remember, when you use this dividend formula, dividend valuation formula, when you use, I'll take this one from here, KE plus G, okay? G I take there. This one formula can be used for 1 share, or it can alternatively be used for the entire company. If you put D for dividend on 1 share, and you put P naught, the price of 1 share, this is one way. The second way is that you are putting the total dividend of the company and you are putting the total value of the company. So value of all the shares and value of all the dividend. So I'm going to use this thing. I've got my P naught, which is 58 million. I've got my D naught, which is 5 million, but I do not have G. G I need to calculate the growth. Now, how do you calculate growth? for calculating growth, either you have historical data, dividends have grown over period like last 3 4 years, and you find out the formula for growth. Remember that growth formula, we discussed it several times. In this particular case, I will be using the Gordon growth model, which says G is equal to BR, where B is the return on equity and R is the retained earning. Okay. So I know that the retained earning is 20%. Whatever they invest, they can get 20% on that. And how much do they invest? So their dividend payout ratio is 70%. It means that whatever they earn, 70% they give out and only 30% they keep in the business and they reinvest. So 30% is the amount which is retained in the business, and that 30% of retained amount is invested at 20%. So I can calculate here 20, you know, 0.02 in, sorry, zero point 0.2 into zero point 0.3, which is 0.06. So you got your growth as 6%. And now what you need to do, you need to put numbers 58 million into 1.06 divided by, sorry, not 58, dividend is 5. So 5 into 1.06 divided by 58 million and plus G, which is 6%. Okay, 0.06, I can say, or 6%, whatever you may say, makes no difference. Now, guys, can you do it very quickly? Solve it on your calculators. Give me the number. I missed something. I did not start recording. Let me just explain it again. So we put these numbers and we got the answer. Answer was 15.1379. If you round it off, it becomes 15.14. But you don't have to give 15.14 because the question says, the question required us to present the answer in nearest percentage. They ask you to write down in the nearest percentage, and the nearest percentage will be 15. Okay. If you write down 15.14, you will get 0 marks. So be careful about these instructions. Whenever you have empty space to write down your answer, make sure that how do I have to present it. Okay. Next is question number 6. The finance director of tracker company is analyzing the yield curve in the euro market to select a suitable financing strategy. Financing strategy means that you need actually cash. About borrowing, you want to borrow money and you have to finance the business. He observes that the yield curve has recently changed from a normal curve to an inverted yield curve. Now, normal curve and inverted yield curve. Normal curve always is like this. So you have got the time period year 1, year 2, year 3, year 4, and you have percentages here. Okay. So for example, what we expect that this is, let's suppose 4%, this is 6%, this is 8%, and so on. Normally, what happens that for long period investments, you ask for a higher return, or the other person also asks for a higher return because the money is going to be locked for a longer period of time. So long-term loans or long-term financing is always more expensive because of the unseen for circumstances. Remember, the more you go into the future, the more risk there is. And if you are taking more risk, you need more return or you have to pay someone more. This is called normal yield curve. When you have an inverted yield curve, which is like this. So it means that in the short period, the interest rates are higher. And as you move further in the time period, interest rates are lower. Okay, that is what is inverse or inverted yield curve, which means that long-term borrowing will become cheaper. Long-term borrowing will become cheaper because in the long term, interest rates are expected to fall down. This is what is inverted yield curve. Now, because they have to do financing and he's thinking about a suitable financing strategy, which two of the following are true in this situation? Bonds with a long-term maturity term will have lower returns. Bonds with long-term maturity term will have lower returns. Okay, makes sense. Tracker company is exposed to rising interest rate in the euro country. No, interest rates are not going to rise actually. Interest rates are going to fall down. The change would have been beneficial for tracker company if it had issued long-term fixed rate debt. No, that is wrong, because in the long term, if we expect that in the long term interest rates are going to go down, you always take a variable rate loan agreement. Because if I get 8, if I sign it today 8% long fixed rate, tomorrow market will fall down, but I still have to pay 8% because my loan is fixed rate loan. So if I expect that in the future market interest rates will fall down, I will never lock myself with 8%. I will say I will go with the variable rate, so that if the market interest rate LIBOR goes down, I will pay less interest. And this is vice versa. If you expect that in the future interest rates are going to go increase, you immediately sign a fixed rate contract. You go to the bank and say, sign me a fixed rate contract so that when tomorrow interest rate goes up, I'm not affected. Okay. So in this particular case, we expect interest rates to fall down. He says that it is beneficial to go for a fixed rate. Why should I go for fixed rate? I expect them to go down. I'll go for a variable rate. So this is not the answer. Raising Eurobonds financing in the euro currency has become more attractive. Yeah, that is also true. Because why it is become attractive? Because I will raise financing and I will do it in the variable rate, and the variable rate is going to go down. So I will get benefit because I'm borrowing money. I have to pay interest, and decreasing interest rates are good for me. So 1 and 4. Number 7. Which of the following is an illustration of the principal agent problem? Now remember that principal and agent problem is about the shareholders and the directors. When the management, the directors, and the shareholders, their interests, they conflict with each other. That is called principal agent problem. I don't want to go into deep detail of this issue, but always remember that directors are running the company. They want to protect their position. They want to give benefit to them. Whereas their major duty or their primary duty is to give benefit to the principals who are the shareholders. So any situation where directors and shareholders, their interest, they conflict with each other, we call it a principal agent problem. Suppliers cutting their cost by using cheaper material, this is not principal agent principle. Directors avoiding debt finance because lower interest payments increase their job security. Shareholders group disagreeing over dividend policy. So this is also not, because this is between one group of shareholders say we need more dividend, another group of shareholders say we need less dividend. So these are shareholders. This is between the shareholders. It's not agent. The stock market exerting pressure on companies, this is not principal agent. This is principal agent. Directors avoiding debt finance because lower interest payments increase their job security. Now, remember that debt is cheaper. Debt is cheaper. So what a business should do? A business should take the debt because the debt is cheap. And that gives benefit to the shareholders. Because if you pay less interest rate, there is more profit. More profit gives benefit to the shareholders. Shareholders would always go for the lower interest rate. This is what the shareholders want. But the directors are avoiding it because of their job security. So that is the answer, because this is what is creating a conflict between the interest of the directors and the shareholders. Question number 8. A project has average estimated cash flow of 3,000 per year with an initial investment of $9,000 with no residual value. Depreciation is straight line, and the project has a 6-year lifespan. 6-year lifespan, no residual value. All of the 9,000 will be depreciated within 6 years. The company has a target return on capital employed ROCE of 28% and target payback period of 2.5 years. So you say that the director says, the shareholder says that we have a target, we need return on capital employed at 28%, and we need a project which gives 2.5 years payback. ROCE is based on the average investment. ROCE is based on the average investment, which means you actually have to calculate ARR, average rate of return, under which investment appraisal method, using the company's targets, will the project be accepted. So, does this project meet the criteria of ROCE, or does it meet the criteria of to payback, or does it meet both of them? So let's first calculate how much is the ROCE. So I will say that investment you can, or this is probably some equipment or something. This is investment value, which is 9,000. Your depreciation will be, you know, 9,000 divided by 6 years, because it has 6 years life, right? So depreciation is 1,500. Your cash, how much cash do they generate? They generate cash as 3,000. And if you subtract the depreciation from the cash flow, you get the profit. This is the profit. And this is actually the average profit, okay? You can call it average profit. Then how much is the investment? And I can call it average investment. Average investment will be opening investment, which is 9,000. So average investment is opening investment plus closing investment, which is 0, because residual value is 0 divided by 2. So that is 4,500. And I can say that my ROCE, which is based on the average investment and average this thing, is average investment divided by average profit divided by average investment. Okay. So average profit is 1,500 divided by average investment is 45, and that gives me 33.33%. So based on ROCE, this project is accepted, because they said that 28% return, you can invest money in any project which brings 28%. Our project gives 33%. So this project is accepted on ROCE. Now, if I see the payback period, so investment is 9,000, and you are actually getting 3,000 per year cash flow. So 3 years. 3 years is your payback period. Payback period desired is 2.5 years. This project gives you 3 years payback period. So this project is only accepted, or it can only be accepted based on ROCE basis. So ROCE only. This is the answer. Want to ask anything? Please ask. Okay, question number 9. Guide Me is a charity that was set up with the objective of training dogs for the blind. Which one of the following performance measures would best fit with effectiveness in a value for money audit? So, value for money, effectiveness in the value for money audit. Remember, effectiveness is that when you achieve your targets, when you achieve your objective. So, you see, what is your objective? Your objective of training the dogs for the blind. Okay, we know that there are 3 E's. You have got your efficiency, you've got your effectiveness. Remember that you've got your economy. Economy means you achieve the budget. You meet the budget. For example, 3 E's. Okay, I have to explain 3 E's of non-financial performance. One is called economy. One is called the efficiency, and the last one is called the effectiveness. Okay. Effectiveness. If I tell you that you have to teach 100 children within $5,000, I give you a budget for 1 year, $5,000, and I say you have to teach 100 children. So if you, during the 1 year, what can happen that you spend $5,000 and you teach 90 children only. So I can say that you have the economy, but you do not have the efficiency or effectiveness because you did meet the budget, you did not spend more money, but you ultimately could not teach the 100 children. Another possibility is that you teach the 100 children, but you spend $6,000. In that case, I would say that economy is not there because you spent more money, but efficiency is there because you did the job. But if ultimately you do $5,000 and you do 100, that is called effectiveness. When you achieve the economy, which is 5,000, when you achieve the efficiency as well, then we say, oh, you are effective. And that's the word we use for individuals as well, that this person is effective, which means that you are, achieving all the parameters. Anyways, this was one simple discussion. So we say that what we are doing, uh, we have to think about the effectiveness of the objective. Objective is training the dogs. So average hour to train a dog. So which one of the following performance measure would best fit with effectiveness in a value for money audit? Value for money audit. Average expenditure on each dog successfully trained. Average hours worked by each dog trainer. Okay. Average hour to train a dog to. This is only talking about the average hours which you are spending. This is only talk about the number of dogs which you are doing. The number of dogs awarded with the Guide Me certification standard. You might have a lot of dogs who are getting standards, but you might be spending a lot of money on that. Okay. So it is only talking about efficiency. This is talking about economy. So this is economy. You are reducing the time. You are training the dogs. Average expenditure on each successfully trained dog. That's the answer. C. That's the answer. Because successfully trained dog and the expenditure as well. Both are done here. This is irrelevant. Average hours worked by each dog trainer. This is the answer because you are considering the economy part and you are doing the efficiency as well. Okay. So C should be the answer. Then we come to question number 10. A company has decided to invest in a new machine which has a 7-year lifespan and has no expected residual value. The machine can be purchased outright for $80,000 using for an 8% loan, so $80,000. Alternatively, it can be leased for 7 years by paying annual rental payments of 14,983, which must be paid at the end of each year, not at the beginning, at the end. When it is at the end, calculation is easy. Um, which of the following statement is correct? The machine should be purchased. Okay, so that's kind of a lease and buy thing. The machine should be purchased because this option has a lower overall cost than leasing. Mora company should not agree to either from form of financing because both will result in negative present values. The machine should be leased because this option has a lower overall cost than purchasing outright. The machine should be purchased because these rental payments are higher than interest payments on the loan. Okay, so it is a lease or buy thing. They've got $80,000. This is purchase price. Another one is 14,983. This is the lease payment. And I have to multiply it because I have to pay it every year and 7 years for 7 years. Okay. So 7-year annuity factor I need to find out at 8%. Now, if you have your tables, you can find it in your table. I don't have the table with me at the moment. What I can do, I can create one very quickly. This is 8%, right? Is equal to 1 divided by 1 plus 8% and power 1. And I will lock this thing here. Got my NVT factor. Okay, my mouse is giving me some trouble. I'm not sure what it is doing. I will change the batteries in a while. 5.20. So I have to multiply this 14, this number, with the NVT factor 5.2064. So what it gives me, 14,983 into 5.2064, 78,000. So I've got two numbers. If I buy it now, it costs me $80,000. This is my outright cost purchase. And if I lease it, it gives me 78. I should be leasing it. The machine should be leased because this option has a lower overall cost than purchasing outright. Answer is C. Okay, we did this question 10. Answer was C, that they should do leasing. And then we do question number 11. It says that a light company or Elliott company is planning a major investment in a new manufacturing unit in the next year. Due to recent concerns that inflation is too high, the government has unexpectedly announced an increase in the interest rates. Increase in the interest rates. Which two of the following statements concerning the impact of government's decision is true? Which two of the following statements are true? Because of this increase in interest rates, the company's cost of capital will decrease. No, that is wrong. Because if interest rates will go up, cost of capital definitely will go up. This is an example of expansionary monetary policy. This is also wrong because whenever interest rates they increase, actually it is contractionary policy because people are not. Expansionary is where people are spending money. Here people will not spend money. Everybody knows that interest rates are more. They will save money, put money in the bank, and start earning interest rates. Start earning the interest income because the banks will increase the interest rates on borrowing as well as lending. Anything. Demand for the company's products may decrease. Yes, this is possible because whenever you increase the interest rates, the demand in the economy goes down because people don't like to spend money. So demand depends on two things. Either I have my own money and I will spend it, or I borrow from the bank and I spend it. These are the only two options. So when interest rates will go up, nobody's going to the bank to borrow because borrowing becomes expensive. So people will not borrow from the bank and they don't buy things. Or if they have their own money, they don't waste or spend the money. They prefer to put it in the bank to earn the interest rates. Okay. So demand for the company, this is a general perception that whenever interest rates will go up, the demand in the economy will go down. So that is true. The NPV of the investment will be then lower than initial expected. NPV will be lower. Why NPV is lower? Because interest rates will go up, your WACC will go up, and when WACC goes up, NPV goes down. We said that the first one, that it says that the WACC will decrease. WACC will not decrease. Actually, WACC will go up, and when WACC goes up, NPV goes down. So statement 3 and statement 4 are correct. I wish you guys would get this type of questions in exam. These are not really very hard. Okay. Okay, we see here. It says question 12, WaveNet company is planning a 1-for-4 right issue. For every 4 shares, you are going to give 1 right issue. The value of the rights has been calculated as 0.5 per existing share. per existing share. Wavenet Company's market price is currently $8 per share. What is the TERP, theoretical X right price, and the rights issue price per share? Rights issue price per share. Rights issue price per share. Okay. So 0.5. Now, this is actually, I need to explain you something here because this question can come in a different way as well. Number one, if you have a share, if you say that 1 for 4, okay, and you say that my share price is $10 and I am planning to issue a right issue for $8, which means that anyone who has 4 existing shares um, can buy 1 share new at $8. Okay. Um, Now, the question is here that what is the value of the right? The value of the right, for example, is the difference between these two, the right issue price and the market price, which is $2. So that is the value of the right. We say, oh, that's the value of the right because this is the value this right is creating. But if I ask you that what is the value per share, what is the value of the right per share? If I say value of the right, you say $2, but value of the right per share. Because do you think that $2 value if anybody can create with 1 share? No. $2 value you can create only if you have 4 shares. So you divide it with 4 and you say that the value of right per share is 0.50. Okay. So value of the right itself is $2 because for every new share you can, for every, if you buy a new share, you save $2. So that's the value. But this value does not belong to every share in the company. For every 4 shares, if you have 4 shares, you can make this saving. If you have 4 share, you can have this benefit. But this is benefit belonging to 4 shares. For 1 share, benefit is 0.50. Okay. So when it says that Wavenet company is planning 1 for 4, they already have calculated, they are not giving you value of the right. They are giving you value per share. The value of the right per share, 0.50. And this is per share. And how many shares if I buy and I can get the benefit? For every 4 shares, I can get 1. So I multiply it with 4. So the value of the right, value of right, I'm not saying that the 0.50 value of right per share, but the value of right itself is $2. So if my market price now is 7.5 and the value of the right is 2, so it means that right issue share should be done at 5.50, right? 7.5 minus 5.5. So we say that, oh, the share price is, no, that is not 7.5. Share price is 8 actually. Share price is 8, right? Sorry. Share price is 8. So market price is 8 and 0.550 I have to subtract from here per existing share, which is minus 0.50, 7.5. What are the answer options? Answer options should be actually, okay. So they ask you, okay, they're not asking the share price. They're asking you theoretical X right price, TERP. Okay, I understand. So it will be 4 shares at $8 will give 1 share at $6. That makes me 32. I'm calculating TERP. TERP, theoretical X right price, the existing shares and the market value. the new share, and what price are you going to issue it? I'm going to issue it for 6 because $2, 0.5 times 4, the difference is 2. I'm going to issue one share for 6. That makes me 6. It is 38. And I divide it with the total number of shares, which are 5. So 38 divided by 5, that is 7.6 or something. 7.5. This is the answer. This is your TERP, 7.50. And then right issue price will be less $2, which is 5.50. 5.50, 7.50 and 5.50. These should be the two answers. I before thought that they are asking something else. Later on, I realized that they are asking for TERP, theoretical X right price. Okay. Next question is question number 13. Telt company is a listed company which has 400 million ordinary shares in issue. Yesterday, the ordinary share price closed at 5. So please pay attention. Yesterday, the ordinary share price closed at $5. 2 days earlier, I mean, before 2 days, the board of directors approved the launch of two new innovative products, but this has not been announced publicly. Product A has an NPV of 40 million. The decision to launch product A will be announced publicly tomorrow. Product B will be announced tomorrow. So this information has not been announced. Product B has an NPV of 160 million. The decision to launch product B will be announced publicly this morning. This morning, today. So this was yesterday. And today in the morning, we are going to announce the information of this, and this will be announced tomorrow. Now, remember that we discussed it, I think, in the previous session as well, when we were doing some class. We said that whenever you issue, whenever a company makes a new product or new project, which will bring some more benefit or that gain, it should reflect in the price of the share, because the shareholders' wealth will increase. For example, if you say that we are going to start a new product which is going to give 160 million, so that is actually increase in wealth of the company. So the company wealth will increase by 160 million. So how this 160 million will be transferred to the shareholders? So this 160 million will be reflected in by increasing the price of the share. Every time you make profits, or every time you have some profitable projects, share price, they go up because the equity will go up. Okay, the retained earnings will go up, equity will go up, ultimately it will be reflected in the market. Now, this timing is very important. This will be announced tomorrow, this will be announced today. Assume all other things are equal and that the capital markets believe the project NPV, both products will be financed using internally generated funds. Now remember that this is the price before announcing this thing. It does not have the impact of these. What will the ordinary share price be at the end of today? Now, this is where it comes. So you announce this in the morning. What will be the share price at the end of today? And this will be announced tomorrow. This has no information. If the capital market is, number one, semi-strong form efficient and strong form efficient. Now, semi-strong form efficient and strong form efficient. I think somebody has put an answer. People are already starting answering the question, because I think we discussed this type of a similar question a day before, if I'm not mistaken. So what will happen that 5.1, 5.4, semi-strong form efficient market. So this is 160 million. This will be announced in the morning, and this will be reflected at the end of today, because it is announced in the morning. Immediately effect will come. And how much effect will come? 160 million. You have 400 million total shares. So $160 million will be divided over 400 million shares. It is going to increase by 0.4. Your current price is 5. So 5.4 in this case. If it is semi-strong form efficient, 5.4 will come. So 5.4 here in semi-strong form. Uh, in a strong form efficient market. Now, what is strong form efficient? Strong form efficient market. So remember, okay, we explained this thing last time. Let me repeat it again. Semi-strong form information is the information which is publicly available. Okay, the historical information plus publicly available information. So if market is semi-strong, which means market only has the information which is publicly available. What is publicly available? This is publicly available, and this became publicly available this morning. So it is also publicly available in until evening. So this will have the effect. But if you think like a strong form efficient market, strong form efficient market means that market has all the information. You can even consider that insider information is also there. So then it means that if you have a strong form efficient market, it means that the market price already has, because this decision was made 2 days earlier. It was not announced, but it was made 2 days earlier. So inside the company, the information was there, and that information is already being reflected in $5. So now, even if they make some announcement, there will be no change. The market will remain same because this decision was made 2 days earlier, and it was an insider trading or insider information which is has already spread in the market. Everybody knows it, and the $5 actually includes the effect of this and includes the effect of this, and therefore answer is option 3, which is 5.40. In strong form efficient, nothing will happen. Share price $5 will include, or it already includes, everything. Question number 4. Which of the following statements concerning the traditional theory of capital structure is correct? Now remember, what was the traditional theory capital structure? It says that uh, debt is cheaper, equity is expensive. We keep on adding debt because debt is cheap. As we add more debt, your WACC, it keeps on going down because you're adding more debt, it is going down because this is debt. The more debt you add, it comes down until it comes to the lowest point and then it increases. So the logic was that there were two conclusions from this particular TT traditional theory. Number one, because debt is cheaper, so as you add more debt, the WACC goes down. This is number one lesson. Lesson number two, that once it comes to the lowest, after that it goes up, and this is the optimum capital structure. This is the optimum capital structure, 70/30, 60/40, 50/50, whatever it is. But this is the capital structure at which the value, the WACC is the lowest and the company value is the maximum. This is what we learned from traditional theory. Now keep that in mind, and then we say which one is correct. There is an optimal capital structure for a company where the market value is maximized. This is actually this is the gist of this TT. Buying and selling of shares by arbitrageurs ensure that share prices are consistent with the theory. No, that has got nothing to do with the capital structure. The cost of equity of a company decreases as its capital gearing increases. No, it says that if you add more debt, cost of equity goes down. No, this is actually opposite, because why it goes up? Because if you add more and more debt, ultimately cost of equity starts going up because ordinary shareholders say there is more risk, give us more money. So this is actually opposite. So this is not the answer. The cost of debt of a company is constant as its capital gearing increases, which means cost of debt is constant. No, no, no. That also changes because at a certain point, the cost of debt will also go up because the lenders will also start asking more money because of your gearing and because of your risk. So this is also wrong. Answer was option A. In exam, you only have to pick up one and you can move on. Many of you people already know this thing. So it could have been done in exam in maybe 20 seconds. I took 3 minutes. But when you are in exam, I have to give you reasons for these, but you don't have to give reason to anyone in exam. You will just pick up option A and move on. Number 15, which two of the following statements concerning the interest rate risk management method of smoothing are true. So smoothing is actually when you have fixed rate loan and interest and variable rate loan, because we are talking about interest rate risk. So interest rate risk, we have borrowings, okay? We have 50 million of borrowing. We don't go and take all of the 50 million borrowing in fixed rate, because tomorrow market may go down, and then we will say, oh, we have locked ourselves at a very higher interest rate, we borrowed money at 8%, now the market has gone down, what did we do? So we don't do all of the borrowing in fixed rate, and we don't do all of the borrowing in variable rate. In fact, what we do, that we split it, and we keep on changing it actually. So we split it between the fixed rate and the variable rate. Some loan maybe 30 million on fixed rate, maybe 20 million on variable rate, and sometimes we change this percentage as well depending on the market. This is what is called smoothing. There is another policy which is called matching. Matching means that if you have fixed rate borrowings, you have fixed rate investments, variable rate borrowings, variable rate investments, and so on. So the debt portfolio will consist of a mixture of fixed and floating rate debt. That is the answer. But it says which two? Interest rate payments will still increase if the interest rate rises. So smoothing does not mean investments will be will with a fixed cash flow will be financed with a fixed rate debt. This is actually this is also a risk management strategy. This is also a risk management strategy, but this is not smoothing. This is matching. So this is not the answer. Full benefit will be obtained from a fall in interest rate. Full benefit will be obtained from a fall in interest rate, and the effect of the net effect will be an interest payment which is fixed overall. Full benefit will be obtained from a fall in interest rate. No, not necessarily. Okay, I'm stuck with these two. Interest rate payments will still increase if the interest rate rises. Yeah, that is the answer. These two things will happen. One and two. The net effect will interest payment which is fixed overall. No, this is not. It can't be fixed overall. A and B, one and two. Okay, so this is actually we hardly did section A. We still actually I picked up all of the questions. I thought I would be able to do it.